What happens when the world's third largest economy runs trade deficits for 5 consecutive years, while its two most important economic relationships begin to fray at the same time? In 2025, Japan recorded a 2.65 trillion yen trade deficit, even as global supply chains reconfigure and tariffs re-enter center stage, raising questions not just about Japan's economy, but about the future balance of power in global trade. If this trajectory accelerates, Japan's role as a stabilizing anchor in the global economic system could weaken. If it stabilizes, it may redefine how mid-sized industrial powers navigate protectionism without open confrontation. If it fails, the consequences would extend far beyond trade balances, affecting currency stability, alliance cohesion, and regional economic security in East Asia and beyond. Japan's modern trade model was built after World War II on export-driven growth, industrial specialization, and deep integration with US and Asian markets. For decades, manufactured goods such as automobiles, electronics, and machinery generated consistent surpluses that offset Japan's lack of domestic energy and raw materials. This structure worked as long as access to foreign markets remained predictable and geopolitical tensions were contained. That environment has changed significantly over the past decade. The 2025 trade deficit marked the 5th straight year Japan imported more than it exported. Although the 2.65 trillion yen shortfall was nearly 53% smaller than the previous year's figure, it still represented a structural imbalance rather than a temporary shock. Exports rose 3.1% over the year, while imports increased by less than 1%, suggesting improvement on the surface. Yet the underlying drivers tell a more complicated story about shifting trade relationships and policy pressure. One of the most significant external factors shaping Japan's trade position has been renewed tariff pressure from the United States. Under President Donald Trump's second administration, Washington imposed a 15% tariff on most Japanese imports. While lower than the initially proposed 25% rate, the measure still marked a clear escalation from tariff levels before his return to office. The policy reflects a broader U.S. strategy aimed at reducing trade deficits and encouraging domestic manufacturing, even at the expense of allied economies. The impact was visible in monthly data. In December, Japan posted a trade surplus of 105.7 billion yen, but that figure was 12% smaller than the surplus recorded a year earlier. Exports rose 5.1% year on year, while imports climbed 5.3%, narrowing the margin. Most notably, exports to the United States fell 11% during the month, highlighting how tariff pressure translated directly into reduced market access. At the same time, Japan's economic relationship with China has become more fragile. Diplomatic tensions, supply chain realignments, and increased scrutiny of technology flows have all affected trade volumes. While China remains one of Japan's largest trading partners, political friction has introduced uncertainty into what was once a largely pragmatic economic relationship. This dual pressure from Washington and Beijing places Japan in an increasingly constrained strategic position. Exports to other regions partially offset these losses. Shipments to Britain, Africa, and several Asian economies increased, and imports from Europe remained strong, reflecting Japan's efforts to diversify trade partners. However, diversification is not cost-free. New markets often lack the scale, purchasing power, or logistical efficiency of established ones, limiting their ability to fully replace US or Chinese demand in the near term. Energy remains a persistent vulnerability. Japan imports nearly all of its fossil fuels, and fluctuations in global energy prices continue to influence its trade balance. Even modest increases in fuel costs can widen deficits, particularly during periods of weak export growth. While renewable energy investments are expanding, they have not yet reached a scale capable of materially altering import dependence. What if US tariffs remain in place or increase further? In that scenario, Japanese manufacturers would face sustained margin pressure, potentially accelerating offshoring or reducing domestic production. Currency depreciation could partially offset export losses, but at the risk of raising import costs and fueling inflation. Over time, Japan's trade model could shift from export maximization to strategic resilience, prioritizing stability over volume. What if relations with China stabilize or improve? A reduction in diplomatic friction could restore trade flows in key sectors such as components, machinery, and consumer goods. However, such normalization would likely come with political trade-offs, as Japan balances economic pragmatism against security alignment with the United States. The outcome would shape not only trade figures but regional strategic signaling. The geopolitical consequences extend beyond Japan. As one of the world's largest economies and a central node in global manufacturing networks, Japan's trade health affects supply chains across Asia, Europe, and North America. Persistent deficits may limit its ability to invest abroad, influence standards, or provide economic leadership in regional frameworks such as the Comprehensive and Progressive Agreement for Trans-Pacific Partnership. For the United States, reduced Japanese exports reflect short-term tariff success but risk long-term strain on an alliance that underpins Indo-Pacific security. For China, Japan's diversification efforts signal caution rather than decoupling, yet still represent a gradual erosion of economic interdependence. For smaller economies, Japan's adjustments offer a case study in navigating great power competition without direct confrontation. The 2025 figures do not indicate crisis, but they do signal transition. A shrinking deficit suggests adaptation, yet the persistence of imbalance highlights unresolved structural pressures. Trade outcomes are increasingly shaped by policy decisions rather than pure market dynamics, and Japan is being forced to respond in real time. As viewers watch this story develop, the key indicators will not be a single surplus or deficit, but policy durability, partner diversification, and how Japan manages pressure from both sides of the Pacific. Trade numbers, once seen as technical data, have become signals of strategic alignment. In that environment, Japan's choices will reveal how power, economics, and stability intersect in an era where globalization is no longer taken for granted.